Welcome to the debate from MacroSpire.com. Before we begin, this content is for informational and educational purposes only. It is not financial advice and should not be relied upon for investment decisions. Past performance does not guarantee future results. Always consult a qualified financial advisor. Today, the hawk and the contrarian go head-to-head on $94 oil is the equity sell-off you can't ignore. Let's get into it.
Crude at $94 with a 4% single-day surge, the S&P down 6.6% from its high, and the VIX above 25. The market is pricing in a regime change, and if you're not defensive right now, you're not paying attention.
WTI was $98.71 6 days ago. It's actually lower now. You're treating a pullback rally in oil like it's the start of a new crisis.
A 4.2% single-day surge isn't a pullback rally, that's momentum reasserting itself after a brief consolidation. And the catalysts are escalating, not fading.
What catalysts? Iran rejected a ceasefire proposal. That's been the baseline for weeks. The market already priced Hormuz risk when oil hit $98.
Israel just killed Iran's top naval commander. Today, March 26th. And Trump's deadline for reopening the strait expires this weekend. That's not priced in, that's a live escalation on a ticking clock.
Every geopolitical flare-up in the Gulf gets treated like it's the one that finally closes the strait. It never does. Both sides have enormous economic incentives to keep it open.
20% of global oil supply flows through that choke point. You don't need it to actually close, you just need the insurance market to reprice the risk. And that repricing flows straight into energy costs and then into everything else.
Sure, but look at what's actually happening in equity markets. The S&P at $651 is 7% off its high. That's a textbook correction, it happens once a year on average. Calling it a sell-off you can't ignore is just fearmongering.
It's not the 7% drawdown that worries me, it's the speed. And it's happening while oil surges and the VIX parks above 25. That combination historically precedes deeper moves, not recoveries.
VIX above 25 is elevated, I'll grant you that. But it's not above 30, it's not panic territory. It's pricing uncertainty, which is exactly what you'd expect with a geopolitical headline cycle.
The VIX isn't just reflecting headlines, it's reflecting the stagflation trap that's closing. Oil at $94 feeds directly into transportation and input costs. The Fed can't cut into that, and they can't hike without crashing demand.
That's the inflation fear I keep hearing, but it's backwards. Oil is still below where it was last week. If $98 oil didn't trigger runaway inflation expectations, why would $94?
Because it's not about the level, it's about the persistence. If oil stays in the $90s through quarter two, that embeds into forward inflation expectations in a way that a one-week spike to $98 doesn't.
And that's a big if. Every oil shock in the last decade has mean reverted faster than the consensus expected. Supply responds, demand adjusts, and the geopolitical premium fades.
This isn't a supply shock from overproduction or a demand blip. This is a military escalation in the most important energy corridor on the planet. The supply response you're counting on doesn't work when the bottleneck is geopolitical.
I actually think the ceasefire asymmetry favors bulls here. If talks collapse, oil is roughly where it is now, that's priced. If there's any diplomatic progress this weekend, oil drops $5 to $10 overnight and equities rip.
You're making a binary bet on diplomacy with a regime that just had its naval commander assassinated. What's the base rate on ceasefire deals closing after a targeted killing?
Fair point on timing, but markets are forward-looking. The assassination could actually accelerate a deal. Iran's negotiating leverage just got weaker, not stronger.
Or it could trigger retaliation that takes the strait offline for even 48 hours, which would send oil well past $100 and turn your garden variety correction into something much uglier.
We've been hearing the strait could close for 40 years. I'm not dismissing the risk, I'm saying the market chronically overprices it, and the panic trade is almost always wrong in hindsight.
Almost always, until the one time it isn't. And the asymmetry right now is terrible for the long side. If I'm wrong and oil drops, you make a few percent. If you're wrong and this escalates, the drawdown is 15 to 20%.
That's the bear case math, and it sounds compelling in isolation. But you're ignoring that being early to risk off is expensive too. Selling the S&P at 7% down and watching it recover to new highs is a real cost.
I'm not saying sell everything, I'm saying the defensive playbook matters here. Rotate into energy exposure, raise cash, and respect what the VIX is telling you. This isn't the time to buy the dip.
And I'm saying this is exactly when you position for the reversal. The panic is the signal, not to hide, but to lean into the assets that bounce hardest when the headline cycle turns.
We'll know by Monday whether that straight deadline produces a deal or a crisis. I'd rather be positioned for the worst case and pleasantly surprised than the other way around.
And I'd rather not pay the insurance premium on a risk the market has overpriced every single time for 4 decades. The reversal trade is where the money is. The hawk, the contrarian, thank you both. What do you think? Let us know in the comments. Read both articles in full at MacroSpire.com. Thanks for listening to the debate.